Hey traders, this is Blake Morrow with Trader 7. I have Mr. Jim Welsh with us from Macro Tides. You know, Jim, it's been a big week in the markets.
Yes, it has.
Big
A lot
week,
of data.
big week, lots of data, lots
Yep.
of central bank activity. What did
Yep.
you learn? You walked away. What did you learn?
That markets are foolish. They really don't understand what the Fed is doing and going to do and continue to do, all right, which has been a theme for most of the last year. They hear what they want to hear. And I think eventually the Fed's going to pull through. You and I talked last week. I wrote in Monday's weekly technical review that given the minutes from the December meeting, had a discussion about, geez, financial conditions have eased a lot. It's kind of working at cross purposes to what we're trying to accomplish. I thought that Powell was likely to push back a little bit against that. He was asked several times during the press conference, and he didn't. Now, afterwards, I was thinking about it, is that, okay, it was in fact in the minutes. They wanted it in the minutes. They wanted people to read that and get that message. At the same time, if Powell had come out Wednesday and made a big deal, now he's like in a pissing match with the markets. I don't think the Fed wants to go there. Instead, he basically said everything he's been saying in other FOMC members for months. We're going to continue to raise rates. We're going to hold it there for a long time. The labor market's extremely tight. You know, are we glad that prices are coming down? Yeah, the market went nuts because he said the word disinflation. Well, inflation is going to come down more. You and I have talked about this since last October. You know, I said in October, it's almost guaranteed inflation is going to come down because of the takeaway values. But that in his November 30th Brookings speech, he pivoted from inflation being the primary factor that they were paying attention to the labor market. And so, yeah, inflation is coming down. He acknowledged that. Well, it'd be crazy not to.
Yeah.
At the same time, he reiterated some points regarding the labor market. So I think his not talking and pushing back about easing financial conditions was he just doesn't want to go there with financial markets.
Well, let's jump into the labor market, because is this where you're talking foolish? Because the obviously we had a great jobs report.
Yep.
Was it weather related? Because you had this big jobs report. The market looked right past it and says, you know what, we're going to rally anyway. Now I know we've come off the highs since then. But I mean, what's today? I mean, everybody's looking at jobs. So we got NFP, we got ISM. What'd you learn from today?
Well, a couple of things. Again, the main narrative is that the economic strength we've seen, and in the February macro tides, I went through a number of reasons why. As you know, last August, everybody was talking recession. I said there's not going to be a recession in 2022. Some of that strength and the reasons why we didn't have a recession last year is going to continue for the first few months of this year. And I think that's what we're seeing. It's interesting. ADP said our number was low because of weather. So, and they do the readings, both the ADP and the Labor Department do it the same exact week. It's the 12th day of whatever week you're in a month. All right. So, yeah, if there was some distortion because of the weather in the opposite direction of the ADP report, again, that number was so big. I'm sure some of the seasonal adjustments are probably out of whack. But the underlying message was that it was a really pretty decent number. Hours worked, I think, ticked up. Temporary workers, which had fallen since August. Not a lot, but some had rebounded. The ISM number, when that came out last month, you and I talked about it, and I wrote about it. Like, hey, if you look at what happened with weather, there was a huge snowstorm from December 23rd to the end of the month. I said, I think that number got affected, and we're going to see it bounce back. It bounced back completely this in January. So there's a lot of latent energy that the economy has from savings, wage income. 26 states increased the minimum wage. Social Security, 66 million Social Security beneficiaries, recipients got an 8.7% pay rate. So there's income coming in. The government is spending money in terms of infrastructure and so forth. So this indicator is the ratio of job openings to the labor market. Powell repeatedly in the last 6 months of last year has referenced this number, in speeches and meetings. Okay, so this is what he said February 1st. All right, substantially exceeds, demand substantially exceeds supply of available workers. When he was asked later on, I do think it's probably an important indicator. He's been talking about it for months and months and months. So the labor market was tight in 2018. The ratio is 1.2. As you can see, back in 2006, it was under 0.8. So the point being is, big name companies have been laying off workers. It gets a lot of headlines, but a lot of those tech workers are finding employment quickly. They got nice severance packages. And the reality is, the unemployment wave hasn't really started to infect the rest of the economy. I think the second half of this year, it will. So again, I just think, the labor market is the key. The Fed is not going to be cutting rates in the second half of this year, which the Fed funds futures still believe.
They're still pricing.
If the unemployment rate's near a 50-year low, it's just not going to happen. They're going to wait. And here's the other concept, which is important. I still think the Fed's going up to 5%. So you got 2 more rate increases, but then they're going to hold it. And what happens, Blake, is as inflation comes down, all of a sudden real rates go from being negative to being positive. I think the CPI is going to be down near 3% in June. If the Fed funds rate is at 5%, that's a 2% real rate. Last month there was 6.5%. Well, it's still a negative 2%. So as inflation comes down, effectively, real rates go up, and that's a drag on economic growth. That's what's coming.
Well, you just said the market thinks that the Fed will be easing, is going to be easing sometime in the future. So what's this chart telling you here?
Well, this is the visual representation of it. This is the Fed funds rate. The red line is the Fed funds rate. As you can see, it goes lateral. And if you look at the bottom where the years are, you can see it says, okay, we're going to stay at 5.1 through the end of 2023. The street up until today, the Fed funds was going to peak at 487 and be down by almost 50 basis points by the end of this year. So they're not talking, they're talking at least 2 cuts. It's not going to happen. And the only reason it would happen is if the economy's really going into the tank. Now, is that what people are pricing in? No, they're pricing in a soft landing because don't you know, we thought there was a recession last summer and the economy just hasn't gone down because of all these rate increases. We're going to have a soft landing. And you can't have a soft landing and get inflation down to stay down. And more importantly, the labor market to really ease up. Because as we've talked before, the Fed isn't just concerned about getting the unemployment rate down for this business cycle, up. They need it up so that when the next business cycle starts, you don't get wage inflation, developing very quickly in that next business cycle. So again, all year or the last year, we've talked about this repeatedly. Wall Street is just wrong. And the reason is the last 20 years, the Fed always cut rates at the first sign of economic weakness, or if the market started to get indigestion. They were able to do that because the inflation rate was at 2.5% or lower. The labor market wasn't at 50-year lows in terms of unemployment rate. The degree of tightness is historically high. It's just a different ballgame. They're not going to use the same rules and approach of the last 20 years, given the cards that have been dealt to them. Wall Street has yet to realize that.
Well, what does that mean
as we approach the second half?
What does it mean for the dollar? Because you were looking for the dollar to create a bottom in the last couple of weeks. It looks like it might have come in yesterday and today. What do you think here?
Yeah. Well, when the dollar got down to 101, wave 1 and wave 5 were just about equal. And I sent out a special update on Wednesday saying, hey, I think this is it for the dollar. I think it's bottoming. I recommended the dollar. I recommended UUP. The rebound, obviously, yesterday and today, reinforced that. I think if the S&P or the dollar closes kind of where it is or a little bit higher above 102.60, that prior, you can see about 10 days, 2 weeks ago, you can see there was a pop So getting above, yes. So getting above that area adds, to me, more weight. The 5-day exponential moving average, which is in red, has the potential to finally cross above the green line, something it hasn't done since what, October? So more and more signs are accumulating. So even if it's making some kind of a low, there'll be a pop and there'll be a pullback. It's going to be choppy. To me, what was really telling, Blake, yesterday morning was, okay, the Fed did 25 basis points. The ECB and the Bank of England did 50, and the dollar went up. That to me was a really strong message. And then obviously today's economic news, which were uniformly snapping back from December numbers, that really added some octane. So again, I think the dollar has the potential to rally to up towards 106, maybe 108. It's just what's the 382 retracement from one? It dropped about 14 points.
Yeah, it's probably somewhere around the 105, 106 level, I would think.
Yeah.
So,
at least go back to where I had that number 4, wave 4 of lesser degree, immediately becomes one of the first targets that one would look for. Then you look at the 382 and the 50%. We'll see if there's 5 waves up. I think that I haven't looked today. I haven't had a chance to look like a 30-minute chart. I'm pretty sure there's 5 waves up with today's move. Well, so all the pieces to me are in place. And the point being is that the dollar was topping in October. I was looking for a pullback to 104.50. And the idea being was as the dollar came down, all the markets would rebound. We'd see yields come down. We'd see gold rally. It rallied quite a bit more than I thought. And we'd see the stock market rally. So my thought has been the last week or two, the dollar's nearing a low. When it bottoms, we're going to see gold pull back. We'll see the stock market pull back, and we'll see bond yields tick up.
Well, we are getting that pullback in gold, as you pointed out, and gold actually put in a bearish outside day yesterday, bearish engulfing, and you just don't really see that too often in gold. But we got a really nasty reversal. What do you make of it here?
Well, the other thing, you're going to have a weekly reversal too.
Yeah,
you made a higher high, and I'm pretty sure you're definitely below. The other thing, the last 2 weeks I pointed out, look at what gold was doing. It was just racing up. Silver wasn't joining in the parade. And historically, intermarket divergence like that tell you that you're near a trend change.
And we had you had a big conversation about that last week.
Yes. Yeah. And so I just didn't have time today to put those 2 charts together. But my conclusion was, and I've written about it in the weekly technical review, this was setting up for a decline in gold. The 382 is 1825. The 50% is, can't remember, it went up $350, 175. So what are we talking, 1880 maybe?
Yeah.
I'm guessing the 50%. So again, from a bigger picture, this could be wave 1 up, and then we're going to get a correction that lasts for a little while in gold. And then potentially this is the setup for a move to new all-time highs. The alternative
that would be something, but it wouldn't be too surprising in this environment. One of the more confusing markets, Jim, has been yields. So what do you make out of the bond market, and what's going to happen in yields here?
Well, again, this is where fundamentalists if they don't use technical analysis, they're missing at least or almost half the.
It's like driving around with like one eye closed.
I think so. I mean, right? We can use a lot of different analogies. And the point being, and I made this the last week or two, and we showed this same chart last week. Hey, the 10-year made a lower low. Well, it did that a week and a half, 2 weeks ago. It got below the December low. The 30-year didn't. Then both yields ticked up. The 10-year then dropped to another lower low yesterday, but the 30-year did not. If you shrink that chart just a little bit, they'll be able to see it, Blake. So this is, again, an intermarket divergence. The same thing that happened between silver and gold is happening between the 10 and 30-year. And this is something that's been very helpful to me over many years. When you see these kinds of divergences, it usually signaling a trend change. And the fundamentals to me, again, where people are just wrong about their assessment in terms of the economy, and that it's going to take a while before we see more definitive weakness. And so what this to me suggests is the 30-year is going to make a run at 399, and the 10-year is going to go up towards the 390.
So for the S&P, this is one of those that everybody wants to know, why do we keep going higher? I mean, stocks continue to blast higher. We're in breakout territory, aren't we?
Yeah, I know. So that is going to get technicians and everybody. And then I hear the fundamentals. Well, the stock market's telling me this and that. These people are stupid. I hate to be so blunt, but that is such a specious.
How do you really feel, Jim?
I think they're fucking stupid. Pardon me.
Wow.
Can you bleep that out? No, I mean, think about it. Yeah. No, I mean, I'm not trying to be obnoxious, but I guess I am being. But again, markets are always wrong at tops and bottoms. In January of last year, what was the S&P telling us? No inflation, no problem, no Fed moves. So now all of a sudden, oh, well, that was just a bad mistake that we're going to ignore. Now, because the market's rallying and cyclical stocks are rallying, geez, that means the economy's okay. I just think people overweight and they believe in that almost blindlessly. So you've got the technology stocks. The stocks that went down the most last year are the ones that are ripping the most this year. I thought we would get up to that blue trend line. I also thought that Powell would push back, that we'd get a sharp knee-jerk decline before pushing higher. I think the same thing. That oscillator at the bottom panel, you can see it's really overbought. It stayed overbought, which again is a sign of internal strength. So I think there's a pullback, obviously starting probably today. And then I think there's going to be another push that gets the S&P above 4195. There is an outside chance we're going north of 4,300. And I say that because the S&P rallied from 3491 to 4101. So what's that? 610 points? Add 600 points to 3764. In other words, A up, B down to 3764, and we're going to get a C wave that takes the S&P up to 43 plus 4350, whatever. That is a possibility. The key will be, what is the nature of this decline? Is it 5 waves? A lot of other things. But I think people's belief that we're not going to have a recession is being bolstered. And at the same time, they think inflation means the Fed's going to cave in the second. I mean, it's like the perfect prescription. If you want higher equity prices, that's the scenario you pitch.
Yeah, and maybe it takes us another 6 months before the market realizes, oh, look, we have a slowdown. Inflation's, come down, but it maybe some, but the Fed's not budging, right?
Right. That's been my thesis for long, weeks and weeks, that there's this window of time where the economy, I think as we get near mid-year, things like a yield curve, leading economic indicators, banks tightening lending standards, all of those things have always, they're at levels, each one of them, that you've had a recession. So 3 out of 3, at a minimum, we ought to get a pretty meaningful slowdown. At some point in time during that slowdown, people, well, maybe we are going to have a recession. And then if the data gets a little worse, maybe it won't be a soft landing. And then while that's happening, the Fed's going to say, this is what we were looking for. We projected that unemployment would go above 4 towards 4.6. They're not budging. And that, I think, is the dichotomy. Again, Wall Street's been conditioned the last 20 years by the Fed. Hey, economy starts to weaken, we're coming to the rescue. And because of everything they've said, we're not repeating the mistakes of the 1970s. We're going to hold the Fed's rate high all of this year for a long time. Again, they can't be more explicit than what they have been. People just have chosen to ignore it. And now they're willing to ignore, inflation indicators that have had an impeccable record going back 50, 60 years. So at a minimum, I look at it as, hey, you're going to, at some point in time, going to get a fairly deep retracement of whatever, if the low is in October and we get to 4,300, you're going to get, I think, a pretty decent retracement, 50%, 618 of that move up when the economy slows. I think it's going to take us down to the October low, but hey, I'm open. We'll take it as we come, based on what's in front of our dashboard or window, as we're driving the car. But I just think that's what's set up, and in a way, the psychology of the markets has shifted so much from last summer. Oh my God, we're already in a recession. So now, hey, we're not. Today's data reaffirms that. It also has implications for monetary policy. So all of a sudden, Blake, my guess is the probability of the Fed rate going down 50 basis points in the second half of this year, that's going to start to, instead of being 60 or 70%, whatever it is, it will start to drop. Yeah. Oh, wait, maybe the Fed will only cut once. Eventually the market's going to come around to, geez, these guys are serious.
Right. And that's where the pain's going to come in. Well, Jim, how do I get your most recent technical review? Because I want to know when the dollar's turning.
Yeah. Macro Tides, send me an email, jimwelshmacro@gmail. I'll send you last week's report. I'll send you the February macro tides. And I apologize for using a word that I really shouldn't have. So I'm sorry about that. But, that is one subject that I have to say I am passionate about, because every single day on CNBC, I hear about the market looking forward. Yes, the market looks forward, but people automatically assume that the market has 20/20 vision. And the reality is it's not any close to that. Gosh, and that's why technical analysis helps us identify when what they saw is not what they're going to get.
You sound like me road raging, driving through traffic at 5 o'clock in the evening in a metro area.
I had a little extra. I had some coffee this morning. I normally don't. And so that'll be my excuse.
I like Angry Jim. All right, Jim. Angry Jim, appreciate you being with us this week. And guess Thanks, what, Blake. Folks? He'll be with us next week, as he is here. If you enjoy his spiritedness today, make sure you give him a big thumbs up, subscribe to the channel so you don't miss any of these interviews. Jim, thanks for joining us this week. We'll catch you next Friday.
Thanks so much, Blake. Have a good one.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.